If you need great advice, then you're in the right place. Financial Forte, Financial Forte.
Buongiorno, benvenuti. This is Mr. Paolo, and I am with my friend, Mr. Sandro.
I don't even know what to say. Buongiorno, Paolo.
Speak with some Forte, please. Fortissimo. Hey, welcome to our show. That was our very new jingle, which is obviously based on Amore, which was a big hit for Dean Martin in particular, amongst others, I think.
I'm still struggling for words. Most people that know me will know I'm never lost for words, but this is one occasion, Paul, where I absolutely am. Although I'm somewhat humbled that you have a jingle now in my memory. If nothing else ever happens in my life, I've got that to look back on.
Yeah, no, it was fun to do, wasn't it, Drew? So anyway, so who's it who said there's nothing? Remind me, which character in history said this? There's nothing certain other than death and taxes. Who said that?
Oh,
we ought to find out, really, hadn't we?
Who is it? I know this.
I thought it was something like Wellington or something like that, or no, maybe it was Disraeli or Gladstone.
Oscar Wilde? Don't know. I'm not sure.
Yeah, well, I think
should we find out?
I think we ought to find out. So, yes. So anyway, so with that in mind, the certainty of death and the certainty of taxes, which of course is very topical at the moment, with the new increase in the national insurance limits. And, of course, living in an era of 25% corporation tax, potentially. Not very good, really, is it?
Well, that's your domain, Paul. But I have to say, I think although this is it's a very dry subject and it's one that a lot of people don't like to deal with, I think just given the time of the year and the fact that in the lead up to the end of the tax year and indeed the calendar year, a lot of people do come to me and say, we've really got to do something about our will. I'm really concerned about inheritance tax, passing on assets to my kids and to my wife or husband. So, I just thought this was a fairly topical one. And I think the other thing to say, Paul, is it's the one really voluntary tax as well, as you know. So lots and lots of different ways to mitigate inheritance tax or death or estate tax, as it's sometimes known. So, we'll explore not just what it is, but how to save it as well today.
Yeah, so inheritance tax, which could otherwise be called the very unfair tax. So this is a tax that basically means you work your arse off all your life, you make loads and loads of money, and then you, having paid tax on all that money, and then you die, and instead of being able to give it to your loved ones, the government basically says, I want 40% of that. Bearing in mind, it's 325,000 the threshold now. So, that if you took a reasonable house in the south of England, that's what many estates would be at least worth the inheritance tax threshold, I would suggest.
Absolutely, I think south or north actually, but 325,000, as you rightly say, Paul, is the what we call the nil rate band. So it's the individual personal allowance for each individual. Obviously, if you're a married couple and you're in a civil partnership, then it's 650,000 because you can transfer your assets to your spouse or civil partner.
Sorry, does that apply to same-sex couples?
Yes, it does. It does.
Because we're very fair on this programme.
I know. I appreciate that, but it does, absolutely. And there is another little exemption called the residence nil rate band that was introduced in 2017. We'll explore that as well because that potentially increases the £325,000 limit to £500,000. So potentially, if you are in a same-sex civil partnership or indeed a marriage and have a spouse, then potentially £1 million worth of exemption between the two of you.
It's very interesting, this. It's a topic that we've discussed before. And in fact, your good friend in the legal company, whose name escapes me for a minute.
Martin Holdsworth.
Him, yes. So we were talking about people's behaviour. So less than a third of people have proper wills that sort of regulate their inheritance tax bills, is that right?
62% of the UK population, adult population, do not have a will.
And of those that do, the 38% that do, are all of those 38% actually consciously doing something about their inheritance tax? Or?
No, I think Paul, and partly the reason why I thought we'd discuss this subject today, as I said, as dry as it is the fact that actually the reason why a lot of people don't plan properly, and a lot of reason why, much of the reason why so much money is collected by the Treasury in inheritance tax or estate tax, is the fact that people are largely ignorant of what they can and can't do to mitigate it.
Yes, and of course we've got the old 7-year rule, so we're going to do a little bit of background to that.
Anything you like, Paul.
Yeah. So basically, it's never too late. So it's quite funny. I've got my longest standing client formed his business in 1953. Still going strong, 69 years. It's a special year. So 69 years into his business in the New Forest. And he still goes to work every single day. And it's quite funny. I remember going to an inheritance tax planning meeting with him about 8 years ago when he was 80, I think it was. And it's quite frustrating because whenever you had a sort of person, you wouldn't want them to be sort of prevaricating. This was a very good example, actually, of intercompany fighting, and in particular, I can't really say on air, a certain member of the family demonstrating massive greed. In fact, I've never seen such obvious selfish, greedish behaviour in my life in this particular meeting. But of course, the point is that no matter how old this chap is, George is, for every year he lives, as long as he does something, then the situation does get better.
It does. And in fact, again, one of the things we'll explore today, Paul, is the fact that actually there are ways to accelerate the inheritance tax savings that you can achieve through careful planning. You mentioned something that we refer to in the profession as a potentially exempt transfer. So it's a gift, an outright gift, where in simple language you say to somebody, there you go, there is an amount of money or an asset. I don't want it back. I want no control over it. It's yours. Keep it. It is an outright gift. And as long as I live for 7 years, at the point at which we get to the 7th anniversary, so 7 full years, that asset or that money is outside of my state for inheritance tax calculation purposes. However, and I came from a breakfast meeting this morning with a good friend of mine, 35 years. I won't mention his name because I don't want to embarrass him. And it's a very, very difficult situation. But sadly, his father's just been diagnosed with cancer. The prognosis isn't good. If he made gifts now, then he's not going to live 7 years. That we know. But there is actually a way to accelerate the tax saving in a 2-year period, which again we can maybe talk about a little bit later on.
Very good. So I'm sure actually in its own little way, this might sound a bit macabre or a bit black humoury, and I do admit to having a bit of a black humour sort of part of me. I'm sure it must be very motivating. I'm just sitting thinking of myself, what I would be like if I was 80, and I was sitting there thinking, right, I'm 1/7 less dead, I'm 2/7 less dead, 3/7 less dead. So obviously if you manage to live for 7 years, then obviously that potentially exempt transfer becomes completely exempt, doesn't it?
It does.
What an exciting day. I'd have a party. I think I'd turn around and say, hey, I am not dead. I am not dead, and I have passed this money on to you tax-free.
Well, do you know what? I mean, you raise an interesting subject here, because in all seriousness, and I do take your point about your rather interesting sense of humour, which is very aligned to mine, which is why I think we get on so well. I'm giving far too much information away, but the reality is that the first 3 years after a gift, there is no tax saving if you die in the first 3 years. After that, it's tapered and it goes down in 20% chunks. I'll keep the language quite simple. So as you rightly say, Paul, at the end of 7 years, the asset is outside of your estate. However, if we go back sort of 30 or 40 years to when my dad was alive and my grandfather before him, typically what parents and grandparents used to do is they would give assets away to save the tax. That's fine. But in the modern era, I think what a lot of people struggle with is giving stuff away and then saying, I recognise I have no control over it. I don't want an income from it. And that is quite unusual for somebody to be in a position where they can just give something away. Nowadays, people say, I kind of want to save the inheritance tax, but I want to keep control of the asset. And that creates a whole different series of financial planning strategies, which again we'll explore in some detail.
So I guess one of the roles I ought to play in our little sessions is sort of asking the question that the retired person looking at an advert on television, a typical advert. So what do we have? We have these adverts extolling the virtues of selling, or effectively using the money from your property to leverage to give to your family or various things. How does that work? And I'm always a bit confused. So say there's a couple. How does that work on sort of first death, second death sort of thing?
So to a point that I made earlier about these two exemptions, you've got the nil rate ban, which is £325,000 per person. If you are a married couple, same sex, civil partnership, as we discussed, and you have children, so there is a natural descendancy, a natural hierarchy, and you were to leave your main residence, typically your home, to your children, typically, then you get this extra £175,000 of exemption.
I was thinking about inside these, liberating your capital schemes. What happens then? Does it equity release?
schemes. Yeah. So if you, one way to mitigate inheritance tax to some extent is to create a debt against your estate. So we refer to that as equity release, where you will go to an equity release lender. And I'll just add a little caveat in here to reassure people that, 15 years ago, equity release schemes were, quite rightly, were criticised because there was no regulation around these schemes, Paul. And what was happening is that people were borrowing money against the value of their main asset, their home. Gross interest was accumulated on a compound basis, and then at the point they died, some dim and distant point in the future, the equity release company would come back and say, you now owe us more than the value of the house, and it was creating chaos. Nowadays, in the regulated world of equity release, there is a cap at which the debt cannot beyond which the debt cannot rise. So for those people considering equity release, it's a much more regulated, safer environment now than it was before. But the way it works, to answer your question, is that if you have a debt against an asset and someone dies, let's say one of the couple dies, normally, in the grand scheme of things, everything passes to the surviving spouse or civil partner. And this is where the first bit of ignorance comes in, because most people assume that if they haven't got a will, that's the mainstay of all inheritance tax planning, if they die, they think, well, everything's just going to pass to my wife or my husband. Actually, in law, the first £275,000 passes by right to spouse, with a 50% entitlement to the balance of the estate. So if you've got £1 million worth of estate, the £1 million doesn't pass legally to the surviving partner. Obviously, if you've got a debt against the estate, Paul, that will come off whatever the total gross value of the estate is before the calculation's made.
Okay, so I think we've done 11 minutes and 50 minutes of talking, so we're going to get into some music. That was Senza una donna with Zucchero, which means sugar, I think. Mr. Sugar, is that right, Sandro?
Zucchero, yeah.
Yeah, Mr. Sugar with Paul Young, of course.
Yeah.
When Paul Young was especially good.
I thought, yeah, he was really good, actually.
I have to say, for those of you who aren't watching Sandro today, he when I saw him this morning in wonderful Ollie's Cafe, get your breakfast here, I saw Sandro's little face, and it reminded me of a college disco when I was 16.
You cheeky beggar.
Yeah, I'm just going to buy you some green Oxford bags, Sandro.
I really like this jacket. In fact, the chap I met for breakfast, who I alluded to speaking to earlier on, it was very complimentary. It's the first thing he said to me.
Didn't say I didn't like it. I was happy when I was 16. Anyway, let's talk more about dying people and taxes.
Well, do you know what? I think we should probably take a step back for a moment and just define what an estate is, because we've used that word a couple of times, Paul. So an estate is defined as belongings in relation to a person, the things they own, including things like savings, property, other assets. And if they are UK resident, it's worldwide assets, as you know. That's really important because wherever their assets are in the world, the only things you can really remove from the calculation are things like funeral costs, debts, as we've mentioned already, and that nil rate band, the 325,000 and possibly the extra 175,000 pounds. And then, as you rightly said earlier on, it's 40% on the rest. So it's a particularly punitive tax potentially. And just taking your earlier comment, Paul, one stage further, we have the government, the Treasury, take away all this money from our hard-earned estate. This is after, of course, we've paid income tax on our earnings and capital gains tax on profits we've made from buying and selling things. So, if you add them all up, it's a lot of tax we pay in our lifetime unless we do some careful planning.
Yeah, you very familiar with the American tax system. I can't imagine Americans putting up with inheritance tax, really.
They actually have 7, I believe, income tax bands. So if you want complicated, just go and live in America. But yeah, I think they tend to tax. They do have an inheritance tax system, but as far as I'm aware, it's not something I'm very familiar with. I just know their income tax regime is quite complicated.
Inheritance tax of envy? ?
Oh, good. That's a good question for debate. Yeah, probably. I think if you look at the history of it, it's the one tax that's never really been touched. There's speculation at every budget that they might do something with it. One thing that is worth mentioning that many listeners probably don't know is that from January this year, January 2022, whereas estates that fell into the inheritance tax trap, so in other words, in more than 325,000, there was a reporting process. even for smaller estates now, that reporting process is now required, but it's all online, so you don't need physical wet signatures. So the whole process of dealing with probate, the administration of one's estate, is much more straightforward now than it was before.
Have to say, just sort of crossing over into my world. So I did, for instance, do a valuation for probate 2 months ago, which I had to redo the report over the weekend, funnily enough. So I would say I get asked usually on customers' businesses to value the share of the deceased in the particular business. And I have to say, I don't think in all of my career I've ever been held to account for my valuation.
Well, credit to you, but then we know you're fantastic.
Well,
no,
I didn't say that for that reason. I'm just saying,
you didn't. I'm saying
that suggests to me that there is no real policing.
Well, we get into the realms of probate valuation. Now, probate valuations, generally speaking, as you know, Paul, are kind of almost like a for sale value that is attached to an asset. So a house, for example, what's a house worth? Well, what somebody's prepared to pay for it, generally. So you can have an open market valuation, which might be X, but if you wanted to sell it in a hurry, the valuation would be Y. And it is, it's a fairly... It's an area of much conjecture because, probate valuations can vary wildly, really, depending on who's carrying out the valuation.
Yes, I think it's always very, very difficult when you're talking publicly, shall we say, to so many people. I think your choice of the word voluntary is very apt, actually. And so I think what my point is that with the right level of planning and with the right advice, the tax of envy can be something more affordable.
Absolutely, and I think what we will do, I'm sure, is go on to look at the ways to mitigate it. I mean, it's all well and good talking about this tax of envy, estate death tax, whatever you want to call it. But the reality, Paul, is that we're here today to talk about ways to mitigate the tax, not just talk about what it is, because that's not of much use to people just to tell them prepare yourself for a 40% tax charge if you can mitigate it. And there are, in almost all cases, lots of ways that you can reduce the liability to zero.
Yeah, and I think one of the things I think about advice is there is no formulaically right or wrong answer. The correct answer is what is right for that person or the couple or whatever it is.
Yeah. And that's a really good point because, as I mentioned before, you could sit down with a couple or indeed somebody that may be single because inheritance tax applies to everybody. And whereas you might have somebody say, we do not want to gift anything to our children at this stage, but we just want to have fun, enjoy ourselves. And if there's some tax to pay at the end of all this, they're still going to end up more than they would have done or we had as kids or whatever. That's one extreme example of how people feel emotionally about inheritance tax. At the other end, to your earlier point, we've paid income tax, we pay capital gains tax. The last thing we want to do is give the government another 40%. Tell me what we need to do to mitigate it. So you start from this, as you say, Paul, a position of understanding what people really want to achieve, how much control they want to retain over assets and the income that they may derive from those assets. And then obviously you come up with a plan accordingly.
And of course, the rather distasteful reality of life is that a large number of people simply don't care. Taking the view that I'm dead, what does it matter? It doesn't affect me. I won't be here.
Well, that's the group of people you can't really do anything for. There's a tax liability. Everyone accepts it, but that's fine. I personally, over the last 31 years, fully respect people that take that view. I may not actually agree with it, but if that's their view of it, then that's absolutely fine, and you plan accordingly.
Yeah. Okay.
Should we talk about some of the ways that we can maybe mitigate?
Oh yes, how exciting.
Well,
we get on to the exciting part of the show now. Who needs music?
Well, the only reason I mention it is because you've just mentioned companies, Paul. So you'll be the first to know that actually one of the ways that you can mitigate inheritance tax is by having a trading company. And if you've got shares in a company...
Business property relief.
And by having access to exempt assets, so those that fall under this business property relief regime... those sit outside of your estate for inheritance tax purposes, as, by the way, as you know, pensions do as well. So if you own pensions, that pension fund is also exempt from inheritance tax. So a lot of people, they retire, and then the first thing they do is start tacking the pension, start dragging all the tax-free cash and all the income out of it, not realising that actually that's probably the last thing on their list that they want to be spending in terms of assets because it's outside their estate for inheritance tax purposes. So there's two ways, plenty more to come between the songs, but But there's two really good ways to get money or assets outside of your estate for that calculation.
Avanti! Quando, Sandro? I am.
You are completely...
Grazie. Right, I have to ask you a question, Sandro. Did you watch the Wales-Italy game?
I did.
Now, how brilliant was the last minute?
Absolutely.
Oh, my God.
Unbelievably
Have
good.
you ever seen anything like it?
And I can't remember the name of the Welshman that got given man of the match.
Josh Adams.
Who then presented it to the Italian...
Fullback.
I mean, this is going well. Just finishing all my sentences for me.
Sorry.
Can you do the next one as well?
No.
No, it's fantastic. I was. People often ask me if England played Italy in rugby, who would you support? I'd be really torn.
We don't have to worry about that because England never lost to Italy.
Yeah, I know, but
The only
I
six-nation team not
probably
to.
would just edge England, same as in football. But yeah, they're definitely the go-to team if England aren't playing.
Do you want an admission? They are my second favourite team too.
Are they?
Yeah, seriously. I'm not saying this because you're here. Yeah. Yeah, so a terrible confession considering I am related to the Kings of Wales, but I was actually pleased when Italy scored.
I've just had a horrible thought. I know this radio station is listened to extensively in Wales, and I've just
lost all my listeners.
Yeah, apologies.
Sorry. So unless you're Luigi from Porthcawl, buy your ice cream, and when you come to Burnham-on-Sea, you come to the Forte parlour, okay? Anyway, let's go back to paying these taxes and talking to the master himself, Siciliano.
Oh, don't say stuff like that. I'll get hunted down.
Your family comes from Sicily, doesn't it?
Napoli.
Oh, it's Napoli. Sorry.
Yeah.
That's better because you never ever related to the Cosa Nostra.
No, in fact, I'm taking my siblings. Shout out to Emma, Nikki, and Marcus. I'm taking them to our ancestral home at the end of May, Paul. I've been there once before. They've never been. It's a bucket list item. So I decided, as we're all getting older and time seems to fly by so quickly, I'm going to treat them all to a long weekend, seeing our ancestral home in the hills of Napoli.
Were your ancestors rich?
No. In fact, the village, they still drag things around by horse and cart. They still pump water from a well. It really is a village stuck in time, 100 years ago. It's amazing.
Molto bene.
Yeah, it's. I'm really looking forward to it. It's fantastic. But let's
talk about tax tips then, Sandro.
Well, shall we? Well, one other thing that we'll talk about. Well, in fact, there's several things we'll talk about. But we've already mentioned wills and the fact that that's a very, very good way to avoid intestacy, which is dying without a will, and all the
dying
implications.
Dying without your gonads.
Yeah. Without a will, all kinds of things happen. As you mentioned, Martin Holdsworth, a good friend of ours, runs a specialist law firm dealing specifically with the problems that people encounter when there is a dispute, which often happens. You mentioned the word greed. It's incredible what happens when oftentimes there's large amounts of money up for grabs. So we talked a little bit earlier, Paul, about gifts, and we talked about potentially exempt transfers. That's an outright gift. There's also gifts that you can make with discretion. In other words, you make a gift. Maybe we make a gift to Drew. We say, okay, Drew, there's some money for you, but
no,
not sure if I'm going to have any more kids or grandkids, so I might want to add beneficiaries. I might want to take beneficiaries away if I fall out with somebody in the family. Works in fairly similar way, except that we call a gift with discretion a chargeable lifetime transfer. And it's very, very important for people to know that you shouldn't be making gifts in excess of the nil rate band, the 325,000, because if you do, you have to prepay. Let me phrase it like that. You have to prepay 50% of the inheritance tax liability, which we've discussed already, is 40%. So you have to pay a prepayment, if you like, of 20% on gifts in excess of 325,000 if there's discretion involved. So that's, but that's again a very effective way of giving money away, so long as you don't exceed the threshold. And one thing that a lot of people don't know is that everyone, but you do, of course, because you're clever, everyone has an annual gift exemption pool of £3,000. So
big deal, eh?
Well, but great for things like school fees. You can give them to kids, you can give them to grandkids. It's a good way of just getting rid of, small amounts of money from your estate. But in addition to the £3,000 annual exemption, you can make unlimited gifts of up to £250 as well.
Right, it has to be me to raise these dark arts, I suppose. Mm-hmm. So it rather begs the question, how does anyone know? So if you don't, so let's say you either do know and you choose to try and buck the system, or which would be true of many people. They just would have no idea of the repercussions of what they were doing. So what if you start giving out huge amounts of money? How does anyone know about it?
Well, I guess the way to answer that one is it's a bit like submitting an income tax return. HMRC are perfectly within their rights to challenge a return. If they find that you haven't submitted the return in a correct fashion, they can pursue the correct amount of tax plus interest plus surcharges, etc. So the answer to your question, Paul, is
but why would they?
Well, the fact of the matter is there is no automatic checking process. The whole taxation system in the UK, in fact in many established countries of the world, rely on the honesty of its citizens. So when it comes to submitting a return for an estate, we call it probate, we are relying on somebody submitting accurate and true records.
Yeah, we're going to talk at all about tax reform, or just talk about the other sides.
We can talk about tax reform.
Because one of the things I was talking to my coach about in my coaching session at Ollie's is in the next financial year, companies are paying corporation tax at 25%, which I think I'm bitterly opposed to. Which again just goes to prove that this government isn't a Tory government, in my opinion, because it's been proven many times over that the best way to leverage more tax collection is to actually reduce taxes, because people are happier to make bigger profits. And so just taking myself as an example, without sort of going and besmirching myself too much publicly, I would be very disincentivized to make £2 million profit and pay £500,000 of corporation tax to the Exchequer. So the analogy of inheritance tax would be, wouldn't a fairer system actually encourage people to keep their affairs better?
I think we're going down a route where we can talk about this all day long, but fundamentally I agree with you. I think in a capitalist society, which is effectively what we are, if you, as you say, Paul, disincentivize people to make profit, if you take with one hand, you have to give back with the other. That's the way the system works. And go back all those years ago where we saw corporate taxation rise. What was the first thing that happened? All the large companies left these shores. It led to unemployment. It led to a reduction in tax collection. So I agree with you 100%. It's a very strange one for me, because whilst we don't want huge companies to get bigger and leave the little man or person, if I'm being politically correct, you don't want the gap between wealth and poverty to get any bigger. It's big enough as it is. But there has to be an entrepreneurial incentive. Otherwise, you can't possibly function in a capitalist society.
So a sporting analogy, being a great horse racing fan, is it's like a jockey beating the hell out of a tired horse at the end when it's already tired. So i.e. the beating becomes counterproductive. So my view would be, we've been through a very difficult period. We're in a position of recovery. So why would you then go and beat the horse with the stick, when the horse actually needs a bit of love, needs to be put out in the field and given some grass and allowed to regrow?
I'm not opposed to the larger companies having an increase in corporation tax rates, but certainly the smaller. I mean, I know that's a again. Do you take from those who are being more successful, because that is the fundamental view of capitalism? It's a difficult debate. What we know is the Treasury has to lay its hands on some money pretty quickly. They can't go after personal tax, because they agreed in their manifesto they wouldn't be increasing.
It didn't stop the national insurance.
But they will argue that national insurance isn't a direct income tax.
Well, they still said they wouldn't raise it.
I know, but that's now we're having a conversation about the fact that politicians generally can't be believed.
Yeah, so I don't know. I'm trying to think how I would put that. I think probably being a straightforward person and a politician don't go together very well.
Yeah, well,
in rare cases, I think they do, which would include people like I forgot his name now, Frank Field, people like him, maybe even Tony Benn. There are people of principle, but on the whole, it's not. You look at Rishi Sunak himself. One of the richest men in the country. Imposing all these taxes on people without caring or seeming to care and not listening, and then find out his wife is basically paying her tax in other shores. No, you could argue quite legitimately, but it doesn't really set a very good example, does it? No. Anyway, so sorry about that, getting a bit political, but I think we've got to talk about all the main issues. I'm sitting here thinking like I'm Julia Hartley-Brewer. So if I put on a red skirt, and start getting whatever, then you'll know why. Anyway, so we're going to play out with two 80s classics, both by Stock Aitken and Waterman. You are listening to Aspen Waite Radio, and as you know, I also do a lot of charity, mate. Not charity. I'm going to come on then, charity, with my great charitable mate, Sandro Forte. He's doing the bloke from...
You've gone Australian now.
I know.
Paul.
Why? Why did it happen? I don't know. I got possessed by Shane Warne. Warney, you're a star, mate. Good stuff. Anyway, welcome back to Financial Forte, and I am Paul, and this is...
Alessandro Marco Forte.
Fantastico. So today, Sandro is mostly, because I'm just listening really, talking about inheritance tax, that grubby word, the death tax, the tax of envy.
Yeah, I'm going to burst everyone's bubble now, because we've just been talking about capitalism and taxes and wealthy people making decisions to take money away from people. We'll just add one little word of warning. For anyone who's got an estate worth more than 2 million, if you're lucky enough to be in that position, then the residence nil rate ban, the £175,000 additional band, if you are, generally speaking, married, have children, and have your own home, is reduced by £1 for every £2 of estate value in excess of 2 million. So at 2.35 million, Paul, the £175,000 residence nil rate band is lost. Of course, if we can find ways to reduce the value of one's estate to under 2 million, then that's a good way to get the residence nil rate band back. The other thing to say about the residence nil rate band is you can transfer it between spouses. So if one dies, or even if there's a divorce, any unused residence nil rate band on the first death can be transferred to the surviving spouse.
I don't know if you know the answer to this question. Do you know how many people in the United Kingdom are technically millionaires?
I do not. I should know that, really, shouldn't I? It's a very large number now, actually.
I mean, it's interesting because I think the correct definition of a millionaire is actually someone that has a net wealth of £1 million. So if you were looking at someone in 1963 that could answer yes to that, then they were a seriously wealthy person. Whereas I would actually say a lot of middle class people in London, for instance, would be millionaires almost inevitably, almost regardless of what they'd done in their lifetime. So I tend to think of millionaires more now as £1 million of cash or liquid assets in my own mind, although it's not technically the right answer. But I think the reason for mentioning it is I would say safely, I would be surprised if a quarter of the people in the country weren't millionaires by asset.
I think that's a pretty good estimate. I mean, if you bear in mind the rise in value of properties, 2.5 million. It's a big number, really. But I think if you, going back to the point you've made about the whole inheritance tax, estate tax being unfair, by virtue of the fact that they've effectively frozen the nil rate ban now for a number of years and will continue to do so in all likelihood, with the increase in asset prices, typically properties, and people's things like, people buying Bitcoin and other assets that are not sheltered from inheritance tax, people's estates are inadvertently rising well beyond now, Paul, the nil rate ban. So a lot more people now than ever before have fallen into this inheritance tax trap.
Yeah, I think it's interesting to look into the questions as to why might a person, because let's be honest, most people, so we've identified the selfish people. We all know those. I can think of a member of my family that is very selfish and just thinks of themselves more than anybody else. But most people aren't like that. I think most people care about their loved ones, etc. But nonetheless, despite that being the case, they don't take the right action or even any action. So why is that? And I think a lot of it is down to emotional reasons. So, for instance, I think people would associate making that a will with challenging their own mortality. Do you think that's true?
I think that's a really good point, actually, because, and I've said this before many times, not just to my own clients and people I come into contact with, we've said it on this radio station before, is that typically you end up in a situation when you talk about money, finance, mortality and everything that goes with it, you've got this diametrically opposed conundrum, which is logically it makes sense to do something. Emotionally, I don't feel I want to do it for the following reasons, and obviously that's different things for different people. But you're absolutely right. A lot of people, and I've often come across, because one way is of dealing with inheritance tax, Paul, is to insure the risk. So if you calculate that you've got an inheritance tax liability of let's say £200,000, one thing that you could do is take out an insurance policy so that the insurance company pay the tax bill. But a lot of people genuinely think that by taking out an insurance policy, they are tempting their own fate, that they are more likely statistically to die than if they don't take it out. Now, that makes no logical sense. It's not backed by science, but it is an emotion that people feel, and you have to respect it. So I think what you've just said is absolutely right. It's a challenge.
Yes, I think I've talked about this before. So I think one of the problems, not just in inheritance tax, but maybe in society generally, is there isn't any effort made to educate at the right age. So maybe if when you were at school you were given you had a few discussions about social responsibility and that sort of thing, I mean, taking it to a more technical level, people can be directors of limited companies with no knowledge. They have no idea as to what the responsibilities are. So it just seems to me, going back into the field of tax, that if you're in a responsible position in a family, you owe it to your family to understand and to be advised.
You've just raised a really, really good point, Paul. I've been saying for years, and in fact with the Professional Footballers Association, we put together an educational programme to help people understand money and tax and something simple like inflation. Inflation is a buzzword at the moment because it's spiralling out of control, because people are spending lots and lots of money. That's what they do when they feel affluent and they've got lots of liquid cash. But then, of course, that inevitably leads to an increase in interest rates. Then they start to feel the pinch and then they stop spending. So I think you raise a really, really good point, and that is one that I think we need to address as a country because it causes all kinds of problems later life.
So just while I think about it, I had a very interesting conversation with one of my best friends, Nigel England, from Clandau, so just to make up for my Italian thing earlier. And Nigel can be a bit of a, it's probably going to rain in a minute, I shouldn't wonder. He said to me very cheerfully, he said, we now live in an era, Paul, where one's wealth will be eroded by 50% every 5 years.
Yeah, I'm not sure where he gets the information from, but actually, if you just...
No, he's talking about 10% inflation for 5 years. That's what he thinks.
Yeah, if you apply that logic, I'm not sure that inflation will run at 10% for the next 5 years, but what he's saying is right. And this is a fundamental problem across the country, particularly amongst young people. They don't understand, we mentioned it last month on the show, they don't understand the value of money and the fact that inflation erodes the real buying power of that money. A loaf of bread in 1980 is not the same price as a loaf of bread today, and people fail to understand that by having £1 in the bank at the start of the year and £1 in the bank at the end of the year, they haven't lost any money, but they have in terms of its buying power, and that's a whole different topic of conversation.
So one of the things that you listeners have got to do tonight, so this is something I would have done as early as when I was 14, is things like worked out the net present value of an annuity in 20 years' time and things like that. And of course, it does make you very aware of the value of money. So I've had that beaten into me from a very, very early age.
Yeah, we are in danger of going slightly off topic here, but I think it's a very, very relevant, very, very relevant point to make, because I don't think you can ever really impress upon people enough that they have to be mindful of the fact that over time the value of one's assets will diminish naturally, natural erosion of assets, which is why you have those conversations around, investing sensibly, making sure it grows at least above inflation. Otherwise, to your friend's point, Nigel's point, you will have a reduction in the capital value of your assets.
Yeah, and of course, then what's starting to happen, we had a discussion in the last show when I was talking about my own situation where I said, you were talking about the level of cash at which people, felt safe. And I said in my own case, it was a bit higher than that. And of course, now I have conflict because if I persist with my medium-term strategy, which has been in place for a while now, then I am going to see very serious reductions. So I'm just about to action a completely new policy, I think, which will still retain some degree of cash withholding, but making what you call making money work for you better.
Actually, on that subject, very quickly before we go into the next link, because you'll start waving at me in a second.
Yes.
There is a reform that's being suggested where life insurance, and I don't mean life insurance in the traditional way, as in taking out an insurance policy that pays out one's death. I'm talking about things like investment bonds. We'll talk about those in a minute because there's a couple of nice little trust solutions that you can use using investment bonds. They are deemed by definition to be life insurance contracts, and the reform is suggesting that life insurance policies will be excluded from one's estate, much as they are now for means testing purposes, even without the need for a trust. So that will be a very interesting reform because that will bring a lot of money that's currently in one's estate outside of one's estate for inheritance tax purposes.
Very good, Sandro. That was on 10 minutes and 4 seconds. You stopped your burbling then. So we're going to kick off the next this hour with two 80s standards. So Donna Summer struggled a bit in the early 80s, but you wouldn't believe it, really. So to some extent, she was saved by Stock, Aitken and Waterman, would you believe? This is actually one of my favourite Donna Summer songs, and This Time I Know It's For Real, which was a big hit, both sides of the pond. And then a song which I think sums up the 80s, actually, and I just signed it one of my happy songs, actually. You Spin Me Right Round, Baby, Right Round. If ever there was a band named for the death taxes, it was Dead or Alive.
Pete Burns.
Of course, it makes a big difference, doesn't it, to the level of tax, whether you're dead or alive?
Yeah, it does. Certainly many more options available to you if
How
you're
do you
alive.
advise a dead person?
You don't. You only advise the people who he or she has left
It
behind.
depends on what you believe in, doesn't it?
Well,
But you're a good Catholic boy, aren't you?
I wouldn't say I was a good Catholic boy. I'm a Catholic boy.
No,
but I wouldn't say I
all the
was a good
Catholics
one.
I know are very naughty because they do whatever they want. They fornicate during the week and then tell the priest on Sunday they fornicate and then they're forgiven.
I'm not even going to answer that question. I have no knowledge of what you're talking about, Paul.
Well, I have to say, that's all the friends I know are Catholics. That's what happens. So, sorry about that. You were about to say something and I interrupted you. What was that?
I was just thinking, we reflect on the 80s and you and I were singing along to Dead or Alive, and I was casting my mind back to those heady days of the 80s, and I was thinking, in a couple of months, hopefully we get some sort of summer, because it's been a dreadful, dreadful last 6 months. And I was thinking about, with the summer brings philanthropy and charitable thought. So I just thought I'd throw in the fact that another good way to reduce your inheritance tax liability is to give at least 10% of your estate away to charitable organisations, registered charities, and you can get a 10% reduction on your 40%. So it becomes 36% effectively.
So just to be clear on this, if you have a £1 million estate, you have to give £100,000 to charity.
To save yourself 10% of the 40%. Yeah.
It's unbelievable, isn't it? What an unbelievable motivation. I mean, apart from anything else, it's not fair. It's not incentivising the charities, is it? It's not incentivising people to give to the charities.
I personally, as you know, Paul, I have my own charitable foundation. I'm a great philanthropist. I love giving my time and money where I can. We donate a percentage of profits from the business. I prefer to do it while I'm alive. I want to leave a legacy, but I like that legacy to kind of unfold in front of me, whether it's a school or a well to supply water to a village in Africa or India or wherever. I'm not quite sure I would get the same satisfaction of knowing I've done something charitable after my death, but it is a very legitimate way of reducing the inheritance tax liability. I just prefer to do it while I'm alive.
Yes, although I suppose if you take, as we are kindred spirits in that respect. So I would say in my case, for instance, I'm living to build a legacy, not to be the richest man in the graveyard, but it doesn't get away from, but I'm not going to be the poorest man in the graveyard either. So both can be true. So what I'm saying is you can do good works during your lifetime and still leave money to charities having done that. Yeah.
Absolutely. And they're taking that one stage further. Another way of saving inheritance tax, if you're one of your offspring is in getting married, you can give £5,000 as a wedding gift, and that doesn't have to be accounted for in your estate as well. So with the summer months coming, when everyone's thinking about getting married, that's another way.
Are you thinking about getting married?
I love the thought of it. As you know, I had a pretty difficult divorce that took a long time for reasons I won't go into. The thought of doing it all again, logically, fills me with dread, but emotionally is something I would love to do because I do believe in the institution that is marriage, Paul. And actually, there's some inheritance tax savings benefits that go along with being married.
Yeah, I mean, Who cares about happiness, Sandro?
Exactly.
Yeah, as long as you're materially better off. That's all that matters in this world, isn't it?
Well, I'm just saying it's a consideration.
No Viva Romantico.
No, I mean, it does have some advantages. I came across a couple not long ago. They'd been together 35 years, but legally, he had no entitlement to her wealth. She was the one with the money. By getting married, there were all kinds, because she's now in very poor health. So just by getting married, we saved a huge amount of potential inheritance tax. So, you know, sometimes people do get married for strategic reasons. I mean, not going to beat about the bush. People do it for reasons other than love, because some people have been together a long time. They say, well, it doesn't change my feelings towards that person, whether I do or don't get married, but I'm doing this for a specific tax reason.
Being the cynic that I am, you could argue most women do.
That's the moment at which I say nothing. I've got 5 sisters and a mum, and they'd all string me up if I answered.
No, actually, my advice to you women is I actually think more of you should get married for strategic reasons, because most men aren't worth, you know, they're just useless lumps of lard. You know, aren't they? In my experience, sorry to be so controversial, most men don't like women, and you know, once the sort of looks have gone, there's nothing left.
I think they might argue the same thing, mightn't they?
So I think you should look at a man like you would a Bond.
Drew, have you noticed how I'm sitting on the fence here? I'm not going down that road. I didn't turn up today to talk about that. Came to talk about estate tax, but
that's why I'm here.
I'm going to leave that bit to you. I'm not getting involved. Should we just change the subject slightly, because I feel rather uncomfortable now.
Good.
So we talked about pensions earlier. You know, many people will know we haven't talked specifically about pensions yet, but as you know, Paul, you can invest up to £40,000 into a pension, or 100% of your income, earned income, whichever is lower, and you can go back up to 3 preceding tax years as well, and bring any unused contributions forward into the current tax year and get tax relief. But again, because I mentioned that pensions are specifically excluded for inheritance tax calculation purposes, if there are some capital assets, some cash floating around, you can add money to your existing pension arrangement if you have one, and immediately mitigate some more inheritance tax from the estate.
Yes, what can I say to that?
I don't know, but I can see by the glint in your eye, you're going to throw something else at me.
Well, no, because obviously as you were uncomfortable talking about the realities of life, and you know, I was just simply dwelling on pensions. You know, what an exciting place to dwell.
I know. I don't even know why I mentioned that. But, you know, for completeness, if we are talking about inheritance tax, it's a very effective way of removing estate, whilst, to my earlier point, retaining control of that asset. Because, of course, if the pension's in your name, you will do just that.
What I would say about pensions, Mr. Forte, Signor Forte, is I think it comes back to life is all about choices, and you know, investment strategy and financial strategy should be unique to the person. So quite often you can get a divergence between what may be, say, tax efficient and actually what you feel emotionally comfortable with. Properties would be a very good example. So on the face of it, a limited company can buy a property. So a limited company can rent a property off a pension fund controlled by an individual that probably controls that company. The rent in the company is tax deductible. It's very efficient. The tax goes into the rent goes into the pension tax free. Mm-hmm. So on the face of it, you've got a beautiful growing capital asset in the pension fund, but it's in the pension fund, isn't it?
Yeah. Well, again, you make a really good point here, Paul, because when it comes to financial planning, and we're not here to talk about what I do day to day, but actually when you're sitting in front of clients who say, oh, well, if it's inheritance tax efficient to put money into pensions, that's what I'll do. The problem is, and I mentioned this comment earlier, what the Inland Revenue tends to hand over with one hand, they take back with another. And in this specific example, by putting money into a pension, you're locking it away to a later date. As we know, with the state pension age rising, the earliest age at which you can access pensions now is 57, soon 58. And then state pension will be rising accordingly, 67, 68 and so on. And I'm sure it will go on probably to 70 before I pass away at some point in the future. So we know that locking money away doesn't necessarily suit a young person, even if it's tax efficient. And also, by holding money in a pension, as we know, only 25% of that fund can be accessed as tax-free cash in the future. And then, of course, you've got this lifetime allowance, which currently is $1,073,100. And what we mean by that is once your pension fund hits $1,073,100, if you're lucky enough to get to that point, then there is a further income tax charge on the income that you would otherwise be taxed on. And that's a 25% surcharge on income and 55% on what should have been tax-free cash. So, you've got to be very careful. And you mentioned the word balance. You've got to get the balance right between doing something for today, doing something for tomorrow, retaining liquidity, because that's important to a lot of people, but also making sure that, I suppose the ideal financial plan is you spend your last pound on the very last day. But, very few people I've ever come across have managed that. So getting the balance right is very important.
So I guess before we get back into our musical journey of the 80s, the other thing, not to talk about now, because obviously we've got 30 seconds, but are we going to talk about legitimate avoidance of inheritance tax? So obviously an obvious way of doing that is not living in the country.
We can certainly talk about that if you'd like to. Depends,
Why not?
Depends musically what you're going to serve up as to whether I'm in the mood to talk about it.
Well, so next I'm going to play the cheesiest song of today. I'm not sure I've confessed this in public before. So it's Brother Beyond and The Harder I Try. Was the wonderful Frankie Goes to Hollywood. And Sandro just raised a very good point, actually, saying that he thought they were a very disruptive band. And, of course, the video itself was Gorbachev and Reagan fighting, and maybe the sort of the threat of nuclear war, etc. And here we are. Who would have thought in 2022, with Putin behaving like more than an old-fashioned Soviet dictator? I think the chances of a world war now have increased. And it's not for. It will affect inheritance tax if there was a war, wouldn't it?
I would think it would affect a lot of things, not least the stock market. But let's not go down that road. It's a very difficult situation. But if you think back all that time, all those years ago, who would have thought 30 years on, whatever it is? Is it? No, it's nearly 40 years on. But anyway, who would have thought all that time ago that a band in the late 80s would be. It's almost like the Nostradamus thing. I'm not suggesting for 1 second for the listeners out there that we should all go building air raid shelters or anything like that. But it's a very, very worrying set of circumstances. It just goes to show, the power one person, particularly one who's as mentally deranged as Putin is, how he can fill a stadium with people he's paid to turn up and all these other kind of things that go on.
We now have 3 KGB agents in our car park. I'm just going to let them kill you because you're offended. I didn't say anything. Hey, Putin man, you're fine.
Well,
what can we say? Anyway, we're going to go back to the wonderful subject of inheritance tax. So, Sandro has this burning desire to tell us about how to accelerate.
Well, just that segue, Paul, that you've kind of inadvertently, but rather deliberately, because you're a pro, have thrown into the conversation, leads me nicely to the point I made earlier, which is a lot of people just think, okay, I give money away, I have to wait 7 years, and then there's no inheritance tax on that gift. There is actually, going back to my friend that I had breakfast with this morning, and I often get a lot of people who say, I'm terminally ill, I'm poorly, I really want to try and find a way, dealing with a lady at the moment who's 86 nearly, who's just sold a piece of land on which there was an old hotel in York, and she wants to mitigate inheritance tax as quickly as possible. So to the earlier point that we made about having a trading company, and shares in a trading company are exempt from inheritance tax as long as you meet certain criteria, you can use the same business property relief, or business relief as it's now called, to accelerate the mitigation of one's inheritance tax liability by 5 years. So as long as you hold something called inheritance tax service or inheritance tax scheme, which, again, a little caveat, risk warning, you're investing in a range of a very diverse range of AIM listed, that's smaller company shares that qualify for business relief. You can, in theory, put money, cash, into an ITS arrangement, and as long as you hold that ITS arrangement for 2 years, there is no inheritance tax liability on the cash held in that in that arrangement. And things like enterprise investment schemes, they also qualify for business relief for inheritance tax purposes, as you know, Paul, after 2 years as well. So there are lots of ways that you can accelerate the inheritance tax saving if circumstances are such that you need to do that and you are prepared to take a little bit more risk. But when we talk about risk is different things to different people. And of course, look at this logically, you'd have to lose more than 40% of the value of your asset in 2 years to be worse off than just simply paying the inheritance tax. That's what I wanted to say.
This is true. Do you think people generally are sufficiently aware of things like the enterprise investment scheme?
No, I don't. But then if they were, people like me wouldn't have a job, would they? So I think it's...
Maybe.
But yeah, there is, going back to what you said earlier, and you made a very good point, this is the kind of educational reform that needs to start at school. People need to be aware, not necessarily about products and solutions, but certainly about the concepts of money, taxation, the way the system works. Most people, if you ask them to describe a capitalist society and a socialist society, couldn't tell you the difference. So unless you've got the fundamental knowledge, going back to what I said last month on the show, unless you've got the knowledge, you cannot make informed decisions around money, finance, tax, and everything else that's associated with it.
Yeah, and I think it's interesting, isn't it, the way the world is. So, in my opinion, just speaking for myself, the way I was brought up, my mother I would call a thrifty person. She's the embodiment of thrifty. So, as a result of the way I was brought up, I started doing things like putting £8.50 a month into an equity law and life policy when I was 17 years old. True. I think one of the things that I would criticise, maybe the wrong word, Drew's generation, for instance, is if you talk to someone like Drew and say, what have you done to provide for your future? They've done nothing, and that would be true of nearly everyone you talk to.
I had a conversation yesterday, Paul, with my 25-year-old daughter Ellie, who's she's the love of my life. She's a delight, but she proudly, and I am very proud of her for this, she said, I've managed to save £500, started in January, and I haven't touched it. That's the first time she's ever had anything outside of the kind of live hand-to-mouth, day-by-day existence. And that's baffling to me, because going back to what you said earlier, I was 21, started my first job working for an insurance advisor in Weston-super-Mare. And without even questioning it, I started saving money into a pension with Abbey Life, as was. And for some inexplicable reason, I just chose 56 as my pension age. And here I am, nearly 54, and thinking, gosh, the almost like the prophecy, the self-fulfilling prophecy of having 56 as my pension age, and hoping that I might well be in a position financially to be able to retire in 2 years. Not, as you know, that I ever would. They'll carry me out of this business in a wooden box. But yeah, you're right. I was brought up in an environment, in a generation, hard-working father who would earn £1 and he would save £1. And that was it was part of his kind of religion, his business religion, and it's something that he passed on to me. I think, unfortunately, in the last generation, that's kind of been lost. I know there's lots of reasons for that, I'm sure. And again, I'm not saying one's right, one's wrong, because, as you say, you don't want to die the richest person in the graveyard. At the same time, I do think you need to be cognizant of the fact that you are bringing up children. There's an environment that you need to create. There's a certain responsibility that we have, not just to our families, but to society generally. So again, that's a whole topic of conversation for another day, I'm sure.
Yeah, so other than contacting us, it's obviously never too late for someone to get advice, and I think I would say it's almost incumbent upon a responsible person to take advice. How does somebody know that the advisor is right for them? What sort of criteria should they look for? That's
a brilliant question, and it's one that get asked all the time, generally by people who have no intention of using me. But no, but in all joking apart, when I try to give very objective, very transparent advice, even if it's not using someone like me, I'd be looking for a few things. I mean, the most important one, Paul, let's think of our own relationship. Do I like this person? Do I trust this person? If you can answer yes to those two questions, you are 9/10 of the way there. I'm not necessarily a believer that you have to be academically brilliant. I mean, it's good that you know your stuff, obviously, but I don't think you need to be the most well-educated person in the room. I think you need to be the most trustworthy. I think you need to be transparent. I think you need to have a commitment to long-term advice and service, because unless you work with somebody who's in it for the long run, I guarantee you will not fulfill your financial objectives. So I think for me, it will be, do I like them? Do I trust them? Are they in it for the long run? And if they are, I think those will be my 3 criteria, because even if they don't know the answer, and I'm not an honest, but I don't know the answer to everything any more than you do. But we're the first to say, do you know what? Don't know the answer. I'm going to find somebody who knows the answer, or I'll look it up. No one wants a smart aleck. what they want is somebody that fundamentally is likable, trustworthy. And as I said, you're most of the way there if you can find those two things, which is rare in the modern world.
Just to pass on a true story of myself, I hopefully have a very exciting new client in Devon, and the couple concerned are currently on holiday on a cruise, and the husband caught COVID during the week I was supposed to meet them, and this is I can't really say what it's about, but it's a significant matter, point in their lives. And I actually said to the wife, we're emailing, and she said, perhaps we could have a Zoom. And I said, no, you really do need to look me in the eye. That was my point. And when we met on the Saturday morning, just show how hard I work, obviously they were able to do that. And I actually remember saying to them, see the benefit. I said, now, at least you know that your business means something to me.
Yeah,
you know what I mean? So
that's a good point. And I've just had a couple of things. Number one, whenever you text me on a Saturday morning, which you often do, I always reply, which shows how hard I work as well, Paul. But
that shows how good your swimming pool is, probably.
but the other thing, again, all joking apart, I run a face-to-face business. Although Zoom has become part of our lives, I believe in social interaction, in that kind of tangible, person-to-person interaction, which I think, again, we won't go down the intergenerational demographical conversation, but I think we've lost that as a society to some extent over the last 5-10 years. Okay,
so we're going to play our final two 80s songs today before a 2-minute link before we come to the end of the show. And the next song, so I'm interested to see what you make of this. The next song is important to me. It's a song from a time when I was in a very challenging job, working for Baker Tilly, but I also had a lot of fun at the same time. And I don't know why. I was listening to the song again last night, and this song is very much an anthem to me. When I look back upon my life, it's always with a sense of shame. I've always been the one to blame. And I don't know what's inspiring about that, but I find it is. For some reason. So I picked the songs for that reason. And then when I was playing rugby, Bucks Fizz were in their pomp, and they had a song called "The Land of Make Believe," which is almost like a pappy wappy song, but it was really funny because this big hunky second row called Hugh that I used to play with, he absolutely adored this song. So Hugh Williams, this is for you. So we've only got 58 seconds left, so Sandra's going to whiz through the 7 things you should do.
Somebody once said to me, Paul, don't grow up, it's a trap. So 7 things, very quickly. Get a will made if you haven't already got one. If you have, make sure you review it. Lasting power of attorney, which basically passes control over your financial and health-related stuff to someone else if you lose mental capacity. Maximize your pension contributions. Look at the shares in any trading company. And if you're selling a company, by the way, you have the option to move some of those shares into trust prior to disposal. It's very tax efficient. Use trusts. Lots of different schemes that we've mentioned before. Make gifts if you have the means to do so. And failing all of those things, insure the risk to mop up any residual liability.
Thank you, Mr. Sandro Forte. That was a pleasure doing the second show with you today, all about death taxes and the Death Star, the Emperor. Anyway, sorry, but no, the Emperor is not in the show. So we're playing out today with cheesy Italian number, Save Your Love, Renee and Renato. Do let us know what you think of the show and future suggestions. Have a great week.